All right, today we're going to go behind the scenes and look at something that's, well, absolutely crucial for our economy: bank stress tests. Think of them like a financial fire drill. A practice run that's designed to stop a tiny spark from turning into a full-blown inferno. So, what are they, really?
It's the question that's probably lingering in the back of your mind, right? Could another 2008 financial crisis actually happen? I mean, we all remember that. It was this painful global lesson in what happens when the whole banking system is just fragile. So, really, what's stopping it from happening all over again?
While the answer, or at least a huge part of it, is the bank stress test. It's pretty simple when you break it down. It's a simulation. Regulators like the Bank of England basically dream up a hypothetical but really, really severe economic crisis. And then they throw it at a bank, just to see if it can take the hit, absorb the losses, and, this is the most important part, keep money flowing through the economy.
Okay, so let's dig into that idea a bit more. Why exactly are we calling this a financial fire drill?
The whole point is to be preventative. I mean, think about it. A fire drill prepares you for a real emergency, right? Well, a stress test does the same thing. It's designed to find and fix the weak spots in the banking system before a real crisis hits and puts all our money at risk. It's all about being prepared, not just reacting. Now, to really get why these tests are so incredibly important, we've got to go back in time a little bit. So, 2008, that was a brutal wake-up call for everyone. You had banks that looked perfectly healthy on paper suddenly just collapsing. Why? They didn't have enough capital to absorb their losses. So, in response, regulators all over the world completely changed their game. They shifted from just reacting to crises to actively trying to prevent them. And that's when stress testing became this mandatory, routine thing. Today, it's pretty much a cornerstone of financial stability.
So what's the big takeaway here? Well, these tests do four really important things. 1, they make a catastrophic system-wide failure a lot less likely. 2, they boost confidence for both investors and, the general public. 3, they make sure banks actually have a big enough financial cushion for major losses. And finally, they help us avoid making the same mistakes all over again.
All right, so we know why they do it, but how does this test actually work? Let's pop the hood and take a look inside the simulation.
It basically breaks down into 3 main steps. First up, the regulators cook up a nightmare scenario, something that's really severe but still, plausible. Then, step 2, they apply this whole stressful scenario directly to each bank's books. They're simulating the impact on everything: their loans, their investments, the whole shebang. And finally, they analyze the results to see just how much damage was done to the bank's capital.
So let's really unpack what this nightmare scenario looks like. And trust me, we are not talking about a small dip here. This is the perfect storm. Regulators are modeling a deep, deep recession, a huge spike in unemployment, a major crash in property prices, and a massive stock market crash. And as if that's not enough, they throw in a sharp rise in interest rates. It's literally a test against everything going wrong all at once.
And here's a really key part of the process. To make it a fair fight, regulators like the Bank of England apply the exact same brutal scenario to all the major banks, all at the same time. It creates a level playing field, right? It lets them see, side by side, which banks are genuinely resilient and which ones might be the weak links in the chain.
Okay, so the simulation is over, the dust settles, and we get the results. So what does it actually mean for a bank to pass? Or maybe more importantly, to fail this thing?
Well, the whole thing really boils down to one critical concept: capital buffers. It sounds technical, but it's just a fancy term for the extra funds, cash, and stuff they can sell quickly, that a bank has to keep on hand. It's there specifically to soak up unexpected losses. The stress test is basically asking a simple question: is your rainy day fund big enough to handle a full-blown hurricane?
And the outcomes? They're pretty black and white. If a bank passes, great. It's proven its capital buffer is strong enough and it can just continue business as usual. But if it fails, there are real consequences. Regulators can step right in and force the bank to hold more capital. They can even stop it from paying out dividends to its shareholders until that financial cushion is built back up.
And look, this isn't just some theoretical exercise. Let's talk about a real-world example that just happened from the Bank of England. They took 7 of the UK's biggest lenders and put them through this exact same grinder, applying that same severe scenario to every single one.
So what happened? Well, the results were actually really positive. All 7 banks passed. They proved they were resilient enough to handle that crazy scenario. And what that tells us is that the rules put in place after 2008, the ones that forced banks to hold more capital and take fewer risks, well, they seem to be working. In fact, the banks did so well, the regulators felt confident enough to actually ease some of the capital rules just a bit, which helps encourage more lending to support the economy.
Okay, so we've gone through a lot of the technical details, but let's get down to the most important question of all. Why should you care about any of this?
Because here's the thing. A resilient banking system is basically the bedrock of a healthy economy. When banks are strong, they can keep the money flowing, even when things get tough. And that means families can still get mortgages to buy a home, and small businesses can still get the loans they need to grow and create jobs.
You can see it right here. That stability that comes from these tests, it translates directly into stable access to credit for all of us. When the system is strong, the whole flow of money doesn't just seize up at the first sign of trouble, which, by the way, is exactly what happened back in 2008.
So yeah, the mechanics of a stress test can seem super technical and maybe a little removed from our daily lives, but its goal, its purpose, couldn't be simpler and it couldn't be more important. It's all about creating a safer, more reliable financial system for every single one of us.
But that leaves us with one final big question. These tests are fantastic for preparing us based on the lessons of the last crisis. But the financial world is always changing, right? You've got new risks popping up all the time, like cyber attacks or the effects of climate change. So the question we have to keep asking ourselves is this: are today's fire drills really getting us ready for the fires of tomorrow?